What I witnessed at the Gigafactory completely astounded me. Though I must admit that what I witnessed completely astounded me in terms of what a robot is capable of. There were no guys wandering around with machine guns and cowboy hats. Indeed, and another thing I admire about this robot is that military fighters encounter many perilous scenarios. Better for me to see that. By the way, that's what Leonardo da Vinci desired. I'm not sure if you know this. In order to save deaths during the European conflicts, he intended to create an armored robot. Now that it has this device, the robot is able to sense his surroundings with some degree of awareness. He has far superior hearing and vision than a human, and in circumstances where other people might freeze and fight, he probably has the ability to think more quickly. This won't ever come to a boil. Humanoid bot creation has surged recently, which is comparable to the growth of electric cars. While Tesla is a notable success in the electric vehicle market, could a similar tale play out in robotics? Some contend that Tesla's strategy, which is based on cost-effectiveness and technological superiority, establishes a challenging standard. Could Tesla's bot succeed where the Model I failed because to its low-cost manufacturing approach? Traders who ride the hype wave, early birds who take advantage of pre-enthusiasm, and the rest of us left holding the bag are the three groups of investors. Are we about to experience history again? Please click the like and subscribe buttons before we respond to these queries. Let's get this video started, and welcome to Tesla Stock News. The harsh truth is that since their IPOs, every EV startup, aside from Tesla, has suffered huge losses. Here, loss is determined by subtracting index performance from performance since listing, which paints a bleak image. It appears that another bubble is about to burst, as demonstrated by the $2.6 billion value of very young companies such as Figure AI. Like its predecessors, Type 1 investors are the driving force behind this bubble. Looking closely at the table, what we find is disturbing. With an astounding 13,743% return since its IPO, Tesla stands out. Unlike many others who are severely in the red, investing in Tesla during the first public offering, IPO, would have produced significant gains. With the exception of Tesla, which has gained 13,743% since its IPO, everything is red. Subtracting that performance from the S&P 500 since Tesla's IPO, I think that's what he's referring to here. We get a return of 13,364% for Tesla. Thus, it wouldn't have required much capital to invest in Tesla during their initial public offering, IPO, and receive a hopping return by now. Consider Workhorse, which lost 96% of its value, or Rivian, which lost 88% of its value after going public. Losses are made worse even when taking into account the S&P 500's performance, with some companies experiencing falls of over 100%. In order to contextualize Tesla's success, it is critical to understand the size of the profits that early investors received. The wise individuals who made an early investment in Tesla saw their capital soar, producing exponential profits that beyond all forecasts. These enormous profits are a result of Tesla's inventive technologies, visionary leadership, and unwavering pursuit of perfection. On the other hand, the state of other EV startups presents a dismal image of the difficulties they encounter. Consider Workhorse, which fell by an astounding 96% after going public, or Rivian, which fell by 88%. These numbers show the intense competitiveness and dynamic nature of the market, in addition to the inherent dangers of investing in developing industries. The losses that numerous electric vehicle startups have suffered are still very apparent, even after accounting for the performance of the larger market, as reflected by the S&P 500. A sobering reminder of the volatility and uncertainty inherent in the world of investing. Some companies experience a 100% decline. Beyond the numbers, these results raise important concerns about the viability of the EV market and the elements that influence its success or failure. What distinguishes Tesla from its rivals? Is it just a question of better technology, inspiring leadership, or calculated foresight? Or are there other, more fundamental elements at work? A more illuminating analogy is provided by the early years of the motor industry. In contrast to the established players in the EV field, the humanoid bot arena is still in its infancy. The EV bubble is a useful cautionary story, but it's important to understand the particular dynamics of the humanoid bot industry. Let's now go back and concentrate on the useful table that was displayed. It offers a crystal clear picture of the effects of the EV bubble. All EV startups, aside from Tesla, have suffered sizable losses since their initial public offerings. A worrying pattern emerges when losses are calculated by deducting listing performance from index performance. It's clear that we're seeing the emergence of yet another bubble, as evidenced by the astronomical $2.6 billion value that up-and-coming businesses like Figure AI are currently commanding. This pattern is reminiscent of earlier bubbles that were mostly driven by Type 1 investors. The source offers an interesting explanation of the different categories of investors. 3 categories of investors propelled the EV bubble: early adopters, PREO, and number 1 investors. If enough buzz was created in the lead-up to the IPO, this group made a staggering amount of money. Owing to their early entry and therefore reduced entry valuation, they frequently obtained significant returns on their whole investment by selling down only a tiny portion of their total ownership at the IPO. The second category of investor includes hedge funds, traders, and others without a pre-IPO stock allocation. This group creates a trading strategy with no long-term holding in mind, taking note of the excitement surrounding the impending listing. Next comes Type 3 investors, which includes the majority of us, investors intending to withhold at the IPO or afterwards. With the exception of Tesla, this group of investors ended up as the bag holder in every EV company listings since they were duped into entering at a greater value and believed the hype. Retail investors are left to suffer the brunt of losses in such instances, while early investors and hedge funds have profited from the hype. Nonetheless, the source's breakdown of investor categories illuminates the market dynamics in operation. Hedge funds and early investors, who are skilled at riding the hype in the market, frequently make significant profits in the early phases of a bubble. When the bubble eventually bursts, retail investors suffer the most since they are lured in by the promise of rapid returns. Throughout history, speculative investing driven by a mix of greed and hype has been a recurring feature in market bubbles. Investors have fallen victim to the allure of easy money on multiple occasions, from the dot-com bubble of the late 1990s to the housing bubble of the mid-2000s, only to suffer catastrophic losses when reality settles in. Let us now examine the comparison made between EV startups and the emerging field of humanoid robots. Though it makes sense to compare them, it's important to understand the differences. In contrast to the well-established players in the EV field, there aren't many incumbent humanoid bots in the relatively new humanoid bot sector. Robots that resembled humans are a paradigm change in technology. Unlike anything before observed, humanoid robots operate in a different market than electric automobiles, which joined one already dominated by large competitors. Human labor is their rival, not other machines. Comparatively speaking, it may be compared to how cars replaced horses, who were animals that carried out jobs until mechanization led to increased productivity. Let's now explore some thoughts shared by co-founders of HumanBots, C.N. Basher and Herbert, a business leading the way in humanoid bot integration. They draw attention to a key distinction: profit margins, which set EVs apart from bots. Bots present an alternative story, whereas EVs, even for Tesla, struggle with low margins and demand large investments in intricate manufacturing and supply chains.